Hello, class. Welcome to Chapter 4. Here we're going to talk about measuring corporate performance. We'll have uh, a lot of information here that will be able to be used when you complete your project. We're going to go over a lot of ratio analysis in this chapter. First, before we get to the ratios here, we're going to deal with value and value added. Looking at this slide, this is really the basis of this course here. On the left-hand side, you have the investment side, and on the right-hand side, is how a company finances things. Should it be debt or should it be equity? Okay, left side for investment decisions is how efficient assets are used. Investment used of assets, turnover ratios, inventory, and accounts receivables. So we'll be using ratio analysis to see how well a company completes the task when we talk about financing, or the investment side, I should say. On the right-hand side, we look at the leverage side, how much debt the organization will take on. We will use leverage ratios such as debt to equity ratios and interest coverage ratios. We'll also look at liquidity using ratios such as the current and the quick ratio. Okay, let's turn to market capitalization and market value added. Market capitalization is one of the best measures of a company's size, also known as market cap. Market capitalization is the total market value of a company's outstanding shares of stock. For example, now I'm using current information here. In the book, they're going to use 2014 of Home Depot. Let's say in 2018, Home Depot was selling for about $200 a share, and stock outstanding was about 1.17 billion. Your value would be about $234 billion. That's a lot of money when we're talking about for a corporation. Okay, when investors want to look under the hood to see how a company performs for its shareholders, they first look at MVA, or market value added. A company's MVA is an indicator of its capacity to increase shareholders' value over time. A high MVA is evidence of efficient management and strong operational capabilities. A low MVA can mean that companies value of the management's actions and investments is less than the value of the capital contributed by the shareholders. Let's use an example here for MVA, or market value added. Is taking the market capitalization figure, which we came up with, which is about 234 billion, minus the equity put in by shareholders of 4.33 billion. So you have a total of $229 billion. Now we're going to use some examples of 2014 in the next few slides here. Here I was using current of 2018. Now 4.3 billion and ends up with a value of 229 billion is not bad. Now let's look at some of the examples from your textbook. Now in your textbook, you'll find a income statement as illustrated here for Home Depot ending December 31st, 2014. And also in your textbook, there's the Home Depot balance sheet. Again, December 31st, 2014 for Home Depot, showing 2014 and 2013. Okay, here we're going to look again, like I said, at the 2014 levels here, and it also shows how the work is done. Again, here market capitalization, you're taking the share of the stock. For this example, was $114.75 times the shares outstanding. Here you have 1,307 million shares. So you had a total market capitalization of 149,978. Of course, that's in millions. And then find out the market value added. You take the this number up here, and minus the equity that was put in by the stockholders, and you'll have a total of about $140.7 million. Not bad, even back in 2014. Okay, let's look at the market to book value ratio before we get into the nuts and bolts for your project here. Here you're going to take the market value of equity, which we came up in the last example of 149,978. Of course, that's the millions, divided by the equity put into it, 9,322. So we had a total of 16.1. Now let's compare that to some of their competitors, or some other companies out there. You can see Apple all the way down to Bank of America, not doing so well here. You can see Apple market value added, which is very high, and they have a market to book value ratio, which is very good compared to Bank of America. It has a negative market value added. May not want to invest in Bank of America, and their market to book value is just 0.60. Okay, let's look at a basic fundamental analysis here. What ratios have to offer. We're going to look at all these. There's 5 of them. You'll have to do 2 ratios per grouping here. So you'd have to have 2 liquidity ratios, 2 activity ratios, and so forth. And we'll cover liquidity, activity, leverage, profitability, and common stock market measurements. Company that I'll be using for my illustration here would be Universal Office Furnishings. And we'll look at the 2016-2015 balance sheet and the 2016-2015 income statement for Universal Office Furnishings when we go through our ratio analysis here. Okay, turning to the liquidity ratio, like I said, you'll have to do 2. Probably one of them you'll do is the current ratio here. So you're going to take the current assets and you're going to divide current liabilities into that and come up with a number here. You can see currently with Universal Company here, they have a 1.34 current ratios. Okay, liquidity ratio measures a company's abilities to pay its debt obligation and its margin of safety through the calculation of metrics, including the current ratio. And like I said, we're also going to go with the quick ratio here. Will be the next slide. Current liabilities are analyzed in relationship to liquid assets to evaluate the coverage of short-term debt in emergency. Bankruptcy analysis and mortgage originators use liquidity ratios to evaluate going concerns issues as liquidity measure ratios indicating cash flow positioning. Now, some people say you're looking for a number around 1, but what you need to do is find out what the industry average is to decide if this ratio is good for your particular company. Okay, many of you guys will also use the quick ratio. The quick ratio is a more conservative version of another well-known liquidity metrics, the current ratio. Although the two are similar, the quick ratio provides a more rigorous assessment of a company's ability to pay its current liabilities. It does this by eliminating all but the most liquid of current assets from consideration. Inventory is the most notable exclusion because it is not rapidly converted to cash and is often sold on credit. Some analysis includes in the ratio, though, is not more liquid than certain receivables. So it's taking out inventories here. Now with Universal here, we can see their current ratio, I should say quick ratio is 1.06. You're going to take current assets and you're going to subtract the inventory. You're going to divide current liabilities, and your number here is 1.06. And I've added a third one in here for you. Technically, net working capital is not a ratio here. Here's where you're going to take current assets minus current liabilities. If a company's current assets do not exceed its current liabilities, then it may run into trouble paying back creditors in the short term. The worst case scenario is bankruptcy. A declining working capital ratio over a long time period could be a red flag that warrants further analysis. For example, it could be that the company's sales volumes are decreasing, and as a result, its accounts receivable numbers continue to get smaller and smaller. Working capital also gives investors the idea of the company's underlying operating efficiency. Money that is tied up in inventory or money that customers still owe to the company cannot be used to pay off any company's obligation. So if a company is not operating in the most efficient manner, i.e. slow collection, it will show up as an increase in the working capital. This can be seen by a company's working capital from one period to another. Slow collections may signal an underlying problem in the company's operation. And as you can see with Universal here, they have a pretty good net working capital of $126.3 million. Now I'm going to give you an example of what I'm looking for. These are two made-up companies, F Company and A Company. F Company, showing you the numbers here for their current ratio. You can see in 2017 it's 1.34. And we're going to talk about benchmark. One of the benchmark is time, and time basically means that you're looking at the company at different time periods. So for this example, the benchmark 27 time is looking at 2017, 2016, and 2015. Okay, we can see here that they were below 1. Like I said, a lot of people said it should be above 1. I state you should look at the industry average here, so we can see the industry average is 1.10. So you can see in 2015 they were below the industry average. Here they were close to it, and in 2017 they were above. So what do these numbers tell you? Well, I see a trend that their current ratio is going up. That's a good sign for F company. Let's look at alpha company here, or A company ratio. In 2015 they were above their industry average. Then in 2016 they were below at 0.88, and in 2017 it's 0.79. So you can see here you could compare F company to its competitor for the current year here. You can say, well, F company is above the industry average. This is what trends or patterns that I see, and they're also doing better than their competitor Alpha company. I also want to bring up something else about the quick ratio. Okay, if the industry average here is 1.10, if a particular company, let's say F company, had a current ratio of 5, that would also be concerned there. That's too much money in a liquid investment or savings. They're earning very little in interest. So that would also be a poor indicator. The company needs to put some of that money into a investment side of it that's going to earn the company more money. So having a high current ratio, especially above the industry average in that particular example, would be a negative also. So what we have 3 benchmarks here. We have time. We see F company compared to A company, and we can see the last benchmark of industry average that you can compare these numbers to. Because just completing these ratios here, like the current ratio 1.34, it doesn't really tell you too much. You have to use a benchmark to compare those two to come up with your trends and patterns.